Let's see, got it. We're being recorded. Let's just give a minute here. What we're going to be talking about today is how to organize your financial information so that you can have it easily and readily available to you, and then what kind of financial information you need to have ready, and what you need to be reviewing on an ongoing basis. And then we'll talk about kind of at the different levels of business, what that looks like, how to organize it practically, what you need to be doing if you're doing, 100,000 a year or less versus if you're doing 250 or a million a year, and at those different levels. So the first thing that is critical to understand when it comes to organizing your financial information is, there's actually a story that I want to tell in this. When I first got my graduated college and got my first job as an accountant, I had a boss whose name was Joni, and she was awesome. She taught me a ton about accounting and about just being a professional, and she was great. Best boss I've ever had. She one of the things she told me was, when we're putting numbers together, we need to know what the numbers should be, and then we can work on actually putting those numbers together, which sounds like funny accounting. It sounds like you're being manipulative, but it's just true. I went on from there to work for a giant multinational company, and it was the same thing. You're always trying to, you need to understand where you're going, and then you can figure out how to get there. There's all kinds of ways within accounting that we can manipulate the numbers to be what we want them to be. So for a big public company that's trying to manage quarter, expectations for that quarter, if they have a really great month, but maybe next month isn't looking so good, they might find creative ways to kind of grab some of that profit and stash it away, usually over on the balance sheet, to then be able to pull it out during a later month. And they use things like accruals and things like that. The accounting piece is not the important piece on this. The important concept is that you have to know what you want to accomplish before you can understand how to accomplish it. And that's really the question that everyone needs to ask themselves when it comes to their financial numbers, is where are you going? Are you self-employed and you're happy being self-employed, and that's just going to be how it is, and you don't really have any desire to grow the business beyond yourself? Or are you wanting to build something that is going to be an enterprise, and that you're planning on being able to walk away from one day, either because you sold it or because you continue to own it but are not operating it day to day? Those are different outcomes, right? You also need to ask yourself, how financially fit do you want to be? I compare it a lot of times to physical fitness, right? If we want to be very physically fit, then that's going to require a different level of dedication than if we're happy, being kind of casual in that area, versus letting go of the rope completely, right? Let's assume nobody's in that camp, but it does require some effort. But for the person who's going to the gym every day and who's maintaining their diet, it becomes something where you put in a bunch of effort at the front, and then maintaining it is not all that difficult going forward, once you build habits, and then once you build systems, and once you figure out the tools to use. But you kind of have to get started. So I don't want to overpromise here and say that you can have all the financial information that you need and be super financially fit without putting in any effort. What I want to do in this training is give some of the tools and some of the things that you need to be thinking about on an ongoing basis, and then try and say, practically speaking, what have we seen work for different businesses of different sizes, and what are the best practices for actually achieving these results with as minimal effort as we can, so that realistically, of course, we all understand there's other stuff going on. We can't just stare at our finances all day. So with that said, there are a couple of things that you should always be looking at in your business. The first one is sales. Now, a big part of what I say is I think there's too much emphasis on sales. I think that there are a lot of people, really great salesmen, ironically, who are sort of selling to business owners that all you need to do to be successful and achieve wealth is just sell more. If you just sell more, everything's going to be fine. I don't agree with that. I subscribe to the sort of like leaky bucket idea that you can put as much in on the top as you want. And if you're not careful, and if you don't have good financial control, it's all going to come out the bottom and you won't actually be left with much or any water in there. So sales are not the only thing that you need to pay attention to, but it would be naive to say that you don't need to pay attention to them. And in fact, you should be paying detailed attention to them. So there are a few things that you should be tracking on an ongoing basis. And we're going to talk about both what you need to track historically and what you need to track going forward. So the first one is sales. So for sales, and then we need to know what sales are to date. And then we need to know upcoming. We can call this pipeline. And then you need to know the, I'm going to use the math symbol because I'm running out of room. You need to know the delta. You need to know what's your go get. If your budget for any given period is X and you know what you have and you know what's coming, what your pipeline looks like, then you know what the difference is. And then with that, now you're armed with knowledge and you can go and figure out and ask yourselves those questions. What do we need to do to achieve that end result that we're after? I'm just gonna let that sit for a second. Okay, now the next thing we need to look at are expenses. And it's very similar. We need to know to date. We need to know our budget. And then we need to know the delta. So with sales, the budget, that sounds very formal. And I'm gonna get into, again in a minute, if you're under $100,000, there's no need to go through like a lengthy budget process. That's going to be time and energy that is not going to be well spent. But you can kind of do some quick math and get a quick idea of budget for what what your expenses are on an ongoing basis. So we're going to get into the practical interpretation of this at those different levels here in a minute. And then sales minus expenses gives you profit, and that's just a number that is the result of those inputs. And the key point I want to emphasize here is all of this stuff, the to date part tells you what has happened, but you have to have that information coming to you on an ongoing basis, right? I don't need to know what happened last year. I don't need to know what happened in 2022. I can't do anything with that number right now. It doesn't do me any good. What I need to know is what happened last week or at the latest last month in June. And with that, then I can take that and say, okay, now let's figure out what's going forward or what we need to do going forward, so that ultimately what we're getting to is this delta here. This tells us what our profit is going to be. So the big complaint that I have with the guys who are just selling sales and saying you just got to sell more, sell more, sell more, is that they're ignoring profit, right? We don't get paid based on how much we sell. We get paid based on how much we have left over after all of our expenses. That's our money. That's the money that we actually make and bring home to pay the mortgage and to feed the family. So what we care about is profit. And if we are tracking our finances in this way, if we're saying not just what happened, what has happened, what's coming, and then what do we need to accomplish in order to achieve our goal, then we can actually work towards a profit goal. And we can say, I want to bring home a profit of X number this year. And we can see on an ongoing basis how we're doing towards that number, so that it's not a surprise and we're not going to, realize at the end of the year, I missed my profit number. I didn't make as much as I wanted this year. That's something we should be thinking about throughout the year on an ongoing basis. I had one thought on that. Darn. Well, I guess it'll come back to me. Okay, so this is what we need to be thinking about in terms of the P&L. The other one, which is not always the same as profit, is cash. So we need to be thinking about cash and what's happening with our cash throughout the year. So with cash, there are a couple of things that we should be looking at. And really, this should be, again, ideally weekly, at the very most monthly. We need to be looking at what cash do we know is coming. So we have beginning cash. How much cash do we have? What cash is coming in? What cash is going out? And you should know that. These are things that can be, easily quantifiable. If you're smaller, then yeah, you don't have a team maybe to help you with it, but you also have fewer financial transactions. So go look at last month. Do you have a credit card payment coming this week? Do you have, is your mortgage bill due this week? Do we, what expenses are coming down the road in the next week or month, and how much are you going to receive in? Cash coming in, cash going out, and then net change. And then we can, within that, part of the cash out is cash that you're transferring. This is from the business perspective, right? So cash out really breaks into a couple of different categories. It could be expenses, business expenses. It could be payroll, and it could be debt payments, and it could be draws. So those are really the four categories of cash out. Cash coming in can be sales, but this has to be cash sales, not just because you invoice someone. Actual cash coming in that is coming in the door. Sales could be financing, and could be that you are like owner contributions, that you are putting money into the business. None of this stuff is rocket science. This is all relatively straightforward, but actually looking at it, what I was going to say earlier that came back to me is, way too often we get busy and we don't want to think about, we'd rather not think about this stuff. So we just go by, all we look at, the only thing we look at out of everything we've talked about is how much cash do we have right now? Do I have cash in the bank? Yep. Okay, good. I'm going to go think about other things, but we're not thinking about what's coming. We're not thinking about how are we doing relative to our goals. And because we're not thinking about these things, we're sort of sticking our head in the sand. And then we say, and then we have surprises that pop up that then take more time and attention because we didn't see them coming, or we fail to actually hit our goals because we have not been intentional about tracking how we are performing relative to those goals on an ongoing basis. So these are the basics. You can build more. For businesses that are much bigger, there are scorecards that you can develop, but that's a little bit of a different angle. Honestly, in terms of basic financial information, if you have everything that we've talked about, in terms of understanding sales that have happened to date, expenses that have happened to date, and where you want to go and how you're tracking relative to that, then and then you have an understanding of cash, both where you're at now and what's coming over the next month, over the next week, depending on what size business you are, then you're good. Like, if the people who review this stuff often, these are the people who are successful. And like I'm in the privileged spot of just being able to observe hundreds of different entrepreneurs and kind of what their common what traits they have and who's succeeding and who isn't. And I'm telling you, it's like it's the same thing. The people who are like going to the gym on a daily basis, or at least consistently a couple times a week, and they have it built into their routine, they're the ones who are also more careful about what they eat, and they're the ones who are, at the end of the day, more healthy. And the people who make the same time and commitment financially, who review this stuff, they get the results. They have financial information. They know what is going on with their finances, and they're able to make adjustments because they're thinking about it and identifying problems instead of sticking their heads in the sand and just hoping that it's going to work out. So now let's talk about how to do that practically at the different levels. So there are essentially three different levels I'm going to talk about here, because beyond that, we just, the conversation morphs, I guess, into a little bit of a different conversation. So those three levels are, we've got entrepreneurs who are under 100,000 annual revenue. So AR, not accounts receivable, annual, let's say annual revenue. So if you're under 100,000 in annual revenue, your business is pretty simple, and you probably don't need to, I don't think at this point you need to hire a bookkeeper. I don't think at this point you need to even have a QuickBooks account. These things can be done at this level very simply. So under 100,000, there are two things that I tell every entrepreneur they have to do, period. No questions asked. First, open an LLC. And that isn't really related to finances, but I'm just going to include it in here anyway. So if you don't have an LLC, just open the LLC, because it gives you options later down the road. So that's one, open an LLC. Two, the key here is separation. If all you do is separate out your business accounts from your personal accounts, so that means you have a business checking account and ideally a business savings account, so you can store extra cash separate that you don't see and use that. That's a conversation for another topic, or it's another topic for another day. But the point is not even those accounts. The point is separate. They don't even have to be business accounts. It can be in your personal name. Ideally, it's a business account. If you have the LLC, you can set it up, under the business. But the point is that you shouldn't have any personal stuff flowing through there. Don't go buy your groceries with that account. Don't pay your mortgage with that account. That's a business account. Only things that are 100% business go in and pass through that account. Now, once you have profit in that account, you can just transfer it over from that account to your personal checking account. Then you pay your mortgage, you buy your groceries, you do all that stuff from your personal account. But the separation is that is step number one. If you don't have separate accounts yet, get separate accounts. That includes credit cards too. It is really common at this level to not have a business credit card, a quote unquote business card. It's usually just a personal card. Again, if you can get a business card, great. There's no reason not to do that, except that it's just not practical. A lot of times it's difficult to get credit for a business at this level, and just the hassle of it. So if you can get a separate business credit card, great. If not, just take a credit card. Take your Amex, take whatever credit card is sort of separate, and have a credit card. If you're going to use a credit card, which most business owners are, then just have that completely separate, only business stuff going through there. You pay it from the business account, and this world is isolated from your personal world. If that's all you do at this level, that puts you better than a lot of entrepreneurs who are at this level. But better than that would be to do a monthly review. Build in time in your calendar. Go in and block off time to do a monthly review. And this should be done always at the very beginning of the month. And ideally, you can follow up throughout the month to make sure, but make sure that you are every single month going in. So you have a monthly routine. A monthly review. And this does not have to be sophisticated, because you have, again, you don't need QuickBooks. You don't need any of that. At this level, how much sales is coming in. What your budget is, but you have to write it down. This can't just be something where, I know, I want to sell whatever. No, get specific. Write down your sales budget. So you need to identify budget, for sales and expenses. And I'm okay at this level if all of your expenses are just in one bucket. Expenses, period. Fine, great. But have a budget for it. What am I going to sell? What am I going to spend? And then how much is going to be left over? That's your profit. Then you go in and you compare your actuals to it. For the same items. And then you go through and look at the delta. So I'm not going to redraw all of that. Point is, monthly routine at this level, and you don't worry about this was an office expense and this was a travel expense and this was a marketing expense. At this point, you know what you're spending money on. And if not, there aren't that many transactions. You can go figure it out if you need to know. How much you're going to sell? How much are you going to spend? Use those broad categories. That's how you do it quickly and efficiently. This shouldn't take tons and tons of time, but the important thing is to just establish the routine more than anything, and to establish the goals so you know what you want. If I'm going to sell this and I'm going to spend this, then my profit is going to be this, and then you can work towards that. And then again, you have your actuals in your budget, and then that leads to your delta. And these are the numbers that you need to be thinking about. That's where you need to be putting your time. And you can't do it if you don't set the target, if you don't set the budget. The biggest miss for early businesses, and it's not just at this level, it goes all the way up to the next couple of levels that we're going to talk about, is they think budgeting is for big businesses. I'm not going to do that. You have to set the targets. Okay. So no bookkeeper and no QuickBooks, usually at this point. It's just you. And that's fine. You can pull up your bank statement, your credit card statement. You can manage, you can pull all the numbers you need that way. Now, above 100,000. So above 100. Okay. And then less than, oh, wrong way. But less than, oh, it was the right way. Less than like 250 is where we draw the line. Now you need a bookkeeper. You're going to be too busy at this point to do it. If you think you're going to do it yourself, prove it to yourself that you're actually going to do it. And then if you actually do, great. You're the rare exception. I was on the phone with someone yesterday who is doing it themselves at this level, and good for him. He's the exception. But most people at this point, they get too busy for it and it falls off. And it's right here. You're starting to make enough. You can pay a lower price bookkeeper and have them start to keep some of this for you in QuickBooks, and it's going to be money well spent. Don't think of I'm going to do another training here in a couple of weeks on like mindset shifts. And this is the point where you've got to decide, am I just someone who's self-employed, or am I going to run a business? Because if you're going to run a business, then you need to start looking at the way you spend money as investments and expenses. And paying a bookkeeper is an investment, because it's going to give you financial information that will enable you to grow your business faster and more effectively and avoid some really painful mistakes. And it doesn't have to be super expensive. There are bookkeepers out there who are pretty economical. It's a little bit of a trap where you get what you pay for, but at this level, you don't even have to have the best bookkeeper in the world. You just need to have someone who does it. And you've been doing it now since that first level. So you know what you need, and you can just tell the bookkeeper that, hey, this is my sales budget for the year. This is what I need to know. And, this is my expense budget. I don't know that, at this point, I still wouldn't even worry about breaking down expenses too much into their subcategories, but you need to start understanding the numbers, and you're going to get too busy and it's going to fall off. So hire a bookkeeper. So at this level, we need QuickBooks, and it doesn't have to be QuickBooks. It's just the most common one, and it's kind of, standard, but there are so many out there. Pick whatever one you're going to use. It's fine. So QuickBooks, let's just call it software. And then a bookkeeper. And I cannot emphasize enough, like this, at this level, you're just getting started. The bookkeeper is just to have someone who's doing it. They don't have to be sophisticated. That's not the point. You don't need a CPA doing your books. You don't need nothing like that. just simple books done by someone other than you, so that you can hold them accountable and make sure that they're doing it, that they're getting you the information. And then you need to be getting reports on a monthly basis. So the cadence, we stay monthly at this point. Cadence is monthly, and you need to be getting monthly reports that go over the same stuff. What's your beginning cash? How much do we think is coming in? What sales do we know are happening that you're going to be collecting in cash? What expenses are going out? What, debt payments do you have? What's all the cash going out? And we have to be looking at this going forward, not just what happened last month, but what is going to happen this month. And then the same thing for sales. What's our sales budget? What's our pipeline? What's the delta? What do you need to accomplish this month for sales? And this report needs to be done by the 5th of the month. That's it. If you're reviewing those numbers after the 5th, you're too late in the month. Ideally, this is happening on like the 2nd or the 3rd, but no later than the 5th. You've got to have this information. Again, this is at this level of business, this is not too much to ask. And it is critical to get you to go to the next level so you don't stagnate right here. All right. The next level, which is the last one that we're going to talk about, is between 250 and 500,000. And then I'll speak briefly about over 500,000, but we're not going to go into it. 200 to 500,000. Now you need to start to look at these numbers weekly. I'll change the color here. And the reason why these need to be weekly at this point is this is the point at which up until now, you really know everything that's happening in your business. And you kind of intuitively have an idea of what's going. The only reason we're doing this more formally is to force you to actually go through the process of holding yourself accountable and saying, what do I want to accomplish? I need to write it down so that I know what it is and what have I accomplished. And then now I can make a plan to make up the difference. Once we get over 250, and especially as we get up more towards 500, this is where business owners will lose track. There's just too much money coming in, going out. It's just too much to kind of hold in your head. And it's at some point during this, in this range, that people just start to lose control of what's going out in expenses. There's just too many transactions, too many things going on. So at this point, you need to be reviewing this information weekly. So now you've got to pay the bookkeeper a little bit more so they can give you these numbers weekly. I promise you that will be an investment that will help you. It feels like an expense. It's really difficult to tie it directly to, you don't get a statement that says this is your return on that investment. This is one of those things where if you have this information weekly and you're looking at financial information weekly, then you are forced to address issues as they come up, and things can't hide, right? You're shining a light on all the areas of your business that you see. What's happening in your business is reflected in the financial statements. That's why we look at financials. It gives us clarity into what's actually happening. And looking at these numbers weekly will help you to go from 250 to 500 and continue to launch above that and be financially secure in the process. This is also the point at which sometimes business owners will get themselves into financial trouble because the expenses can start to run away. They start to focus more on, I'm going to get from here to that $1 million. And they start to think sales. They're not really connected very closely to the expenses, and the expenses start to take off without anyone realizing it. So it's got to be weekly. The other thing at this point is you need to really make sure that you have good accounts. So you need to start to track your expenses ideally in all the different categories at this point, but you really need to be thinking about cost of goods sold, or sometimes we just call that cost of sales. When you receive $1 of income in either of these first two levels, more likely than not, it's your time that you're trading for it, and it's not, you're not having to think too much about cost of sales. At this point, you're likely getting to the point where you're trading, you are paying hard costs to deliver the result for your clients or customers. And you have to have a good understanding of, when I sell something and bring $1 in, how much does it cost me just to deliver what I sold? And that will vary by industry, but it's got to be over, for almost any industry, it's got to be greater than 50%. So you bring in $1, what does it cost you to deliver the results, to deliver what that person paid for? And that number had better be less than 50 cents. And you have to be watching it. Ideally, generally this is 50 cents, anywhere from 50 to like 75 cents. So 75%. But you have to know those numbers, and you got to be tracking expenses separately. Cost of sales, this is what it requires for you to deliver the service. Different than overhead. That's the other category. So when you have overhead expenses, this is the building, if you have one, the travel expenses. If you have like an administrative, so your bookkeeper would be overhead. You don't pay your bookkeeper to deliver the services to a client. They're helping you with company stuff. So that's overhead, COGS and overhead. At this point, you got to start tracking those two things separately. The other thing that really comes in at this point is you're selling enough now that you really need to get into your pipeline should start to develop into something that's more formal, where you're actually tracking leads and getting a little bit more detailed about, when I say that I'm going to accomplish X number of dollars in sales this month, how do we put names to that? How do we make those plans actually more consistent, and tracking that pipeline so that you can get more detailed about hitting your sales goals each month. And again, just because the numbers are bigger, start to get bigger at this point. And so you've got to get a little bit more granular, so that you don't have, was that saying aim small, miss small, right? So you want to tighten in your aim, because the scope of things starts to get big. So if you're not aiming small, then you can have big misses, and that has big financial consequences. And the other thing that you have to start tracking weekly at this point is your cash, which really we're talking about everything weekly, but the cash flow becomes critical at this point. You really have to dial in. So there's no conceptual change at this point. It's more of just an emphasis on cash, just because the cash is moving a lot faster. So a little mistake gets compounded much more quickly, and you've got to every single week be looking at, how much cash do I have today? How much cash is coming in this week that I know for sure? And then how much cash is going out? And then if there's a shortfall there, then you need to go and fix that solution. And you can use, obviously, there are different levers you can use. You can sell something else if you can collect it this month. You can find some financing, draw on a line of credit, something like that, but know about it proactively. Or you can make owner contributions to bridge a gap. But honestly, if you're doing this weekly, the thing that you'll find here, and this is the part, right? How do we prove the value for things that we don't, that don't happen? How do you prove the negative? So the healthy person who doesn't have a heart attack, they never really knew that they would have. And for businesses, this can often be the thing that gets washed under, or swept under the rug in terms of priorities, because it's the things that don't happen. That's what you're doing here. You're maintaining a healthy financial organization so that you don't have to stress about making payroll, or stress about, stress about just failing to hit your objectives, failing to sell what you told yourself you would. And those negatives can be difficult. It's just what's that saying? We don't think about air until we don't have it. And same thing, we don't think about money until and unless we don't have it. So it's really preventative, but I can strongly attest to the correlation between business owners who take ownership of their finances and the ones who kind of stick their head in the sand and just look at how much cash is in the bank, and that's it. The other thing that this allows you to do, if you have these numbers, it's very easy to do tax planning. A lot of what we talk about is tax. And a lot of that is dependent on if we know what's coming, or if we have a really good guess at what's coming, then it's a lot easier to make a really good plan and make sure that we know exactly how much how much tax you're going to pay. We know exactly what steps we want to take to reduce it, and we can make those plans confidently. But we have to know what the numbers are. So the reason I wanted to go through this is because I get a lot of questions from business owners at these different levels. I say, well, what do I need to do? And it really is different, right? We've talked all the way down at this level. We're not even looking at a QuickBooks account, and we go from there, step one, step two, all the way to, we've got to know what's coming in, how much we're paying to deliver those services, and then how much, breaking that down to an overhead level as well. So it really matters, kind of at what level you're at. But I hope this has been helpful in terms of getting an idea on how you can approach this in a way with minimal time. And I'm happy to take any questions that we have, if anyone has one. Otherwise, we'll wrap up. And then Jared, if you want to look on the live stream and see if there are any questions there as well, we can do that. Okay. Jim, good question. So Jim asked if this needed to be something that was done, like if there are any concerns about liability with having personal accounts, like if you have a personal business account or a personal credit card, if there's concern about liability, because you are, I assume, Jim, that you're asking because we're kind of technically commingling, right? The account is in your name. What legally matters more than whose name on the account is that separation piece. So if the account is in your name, like really legal liability is, I gotta be careful not to play lawyer here, but it is kind of the sum of a bunch of different facts. It's not any one thing necessarily. So it would be great. That's why I did say that. Like, it would be great if we could just have these in the business's name. I just don't want you to get hung up on it at this point. The big thing under $100,000, the big thing is you've got to get, to be honest, I don't mean to be like demeaning, but you don't have a real business yet. This is just, it's almost still a side hustle at this point. You've got to get it going. You've got to get sales going. So we want to keep the financial stuff at the level of keeping you accountable, not of like worrying about the minutia. So that's why I would say don't worry too much about the accounts. Again, ideally put it in the business name. It's better if you can, but from the IRS's perspective, they actually don't care at all. The IRS does not care if it's in the business's name or your personal name or your grandma's name. That's maybe taking it too far, but the key is separation. They don't want to see one account that has your groceries come in, and then you're paying for a contractor for the business in the same account. Keep them separate. That's the key. So let's see. Thomas has a question. I have an LLC related question specifically on filing status and changing it as you get started. Great. Thomas, do you want to unmute yourself? There we go. Hey, Thomas.
Hi, Brian. Yeah, thanks. I just I was just on a call before this, getting my LLC actually going and starting to register it, and an topic came up about the filing status when you're getting started. And there's the kind of get in the weeds a little bit in this. I'll try not to too much, but there's the SS4, I believe, form that you file when you first get your LLC going, and that's the one you register with the IRS. This the attorney was telling me that that's the default because you're a sole proprietor. But then as you're getting going, you may want to consider changing your filing status. He was talking about something in between that and your S Corp status. And I was getting confused in there because I hadn't heard it explained that way before. If that makes sense.
Well, I think I understand what you're saying, but it doesn't make sense from the point of view of trying to interpret what the attorney was saying. I can't think of anything that would be in between sole proprietor and S Corp. I'm going to explain it a little bit differently. There are there are two types of entities. There are legal entities, and then there are tax entities. What I was saying up here at this level is that we need an LLC, right? And that LLC is a legal entity. There is no such thing. There's no such thing as an LLC for tax reasons. So if you open an LLC, that is completely legal. Like it's on the legal side, period. The default, which is what your attorney was saying, is that for LLCs either have one member or they're multi-member, anything more than one. If they are single member, then they default to what's called the disregarded entity. And the IRS basically says, that's great that you have an LLC, that's a legal entity. It means nothing to us. And so we're going to tax you as a sole proprietorship or self-employed individual. And that might be fine. That's why I say open the LLC, because if that's all you do and you open the LLC and it makes sense for you to be taxed as a sole proprietor, then great. You know, that we're good with that. If you have multiple members in an LLC, then that's going to default to be taxed. So single and multiple, then that's going to default to being taxed as a partnership. And that really is, I don't think is your case, Thomas, but just kind of to clarify. So an LLC is either going to be disregarded if there's one member, or it's going to default to be taxed as a partnership with multiple members. Then you have the option of choosing, which is why I tell people to open the LLC, because it gives you this option, right? So let's say in year one, hypothetically, someone opens a business, they only end up clearing, $15,000 in profit the first year. There's no need to go with an S corporation. We're fine with the disregarded entity at that point. Great. But we have the LLC, and it's maybe June, midway through the next year, when you realize, oh man, things are taking off. I think I'm going to have, $100,000 in profit this year. Great. Now the LLC was already in place. So now we can go back and we can say, hey, IRS, this LLC that was disregarded, we're going to elect out of that disregarded entity status, and we're going to elect to have it file as an S corp. That is a tax status. So same LLC, same legal entity, but we move it to an S corp. And then LLCs can also be taxed. I'm going to leave trusts out for a second. Well, not for a second. I'm going to leave trusts out, but there's also C corp. And really, an LLC could be taxed as any of these. An LLC is just the legal entity. And then you can make an election with the IRS to say, hey, I want to have this taxed in this way. And it's the same legal entity. There are other types of legal entities, of course. There are actual, traditional corporations. Wrong way. And there are, in some states, not all states, because that's where you form the entity, it depends on the laws in that state where you form it. Some states have S corps as an actual type of legal entity. And those are the main ones. But for small business owners, it's almost always an LLC. And then you choose the tax election on that LLC that makes the most sense for you. So those are the types of legal entities, Thomas. There's no, unless I'm having a brain fart, and I don't think I am, there's no other type of legal entity. So you're either going to be a disregard, but then you open the LLC. The other way I describe it is the LLC is kind of like a bucket, right? So you got that bucket that is the LLC, and by default, it's disregarded. So it's like you're holding the bucket, and it's right there with you. It's all in the same circle. And then so it's again disregard. The IRS says that's nice that you have your little legal bucket there. We don't care. You're all the same thing. And then when you elect the S corp, now you're setting the bucket down and saying this LLC is going to be taxed as an S corp. And you take a couple steps away from it, and you say, I'm over here, and that's over there. It's going to file its S corp return. I'm going to file my individual return, but it's the bucket hasn't changed. It's the same LLC in both of these scenarios. It's just your tax election. Does that make sense?
That does, yeah. It simplifies what I was trying to put in my head. I know you talked about that a little bit last time too, and this gives some more detail. It's just maybe it's the way he explained it, but it just sounded like there was some other election you could do between, sole proprietor and S corp, but it doesn't sound like there is.
It might be referring to the election, like that you then make when you fill out the SS4. He's right that you would fill out the SS4, and probably if you're not ready to be an S corp yet, you would just do the default and say, this is going to be a disregarded entity. I'll report it on my own tax return. You still get the EIN, but the IRS is saying, get the EIN, but we're expecting this to just be on your own tax return. And then it is a second election to elect to file as an S corp, but there's nothing in between the two. Make sense?
Okay. Yeah, that does. Okay. So there's not another step in there. It's either your SS4 defaults to your sole proprietor, and then you're essentially making that election without making it because it's all you can do. Right?
Yeah, that's right. Well, when you form an LLC, you don't even have to file the SS4. You're like a lot of LLCs that people are using just to hold real estate sometimes they don't even file the SS4 for the legal entity still exists, but it has no EIN, no federal ID number. You file that SS4 to get the EIN, and that is sort of step one. I want the EIN, right, so that I can operate and open a bank account. You'll need that to open a bank account. But yeah, it is default, but theoretically, you could file that same SS4. Not saying you should do this, but like that SS4 is all you're doing is saying, hey, I've got an LLC. I want it taxed in one of these four ways. And it sounds like for you, they're saying, okay, let's start out with disregarded. I don't disagree with that. But you're making an initial election there. And then all you're doing when you do the S corp election, which is with the it's a different form, but you're just making a sort of an election that supersedes that first one. Say, hey, now we're an S corp.
Okay, that makes more sense now. So just keep it simple for starters, basically. Right.
Yeah. So I suppose there's two steps at most, but the first one, the SS4 isn't even necessarily required. Right. But if you want the EIN, then it is. So
which I do. Yeah.
Initial election, and then your S corp election, which would just supersede that.
Okay. Well, that helps. Yeah, that helps. I'm glad I asked that. Thank you so much for your time on that.
No, you bet. Thanks for the question. Yep. All right. Any other questions? Okay. I think that's it. We'll go ahead and wrap this up. Thanks. I appreciate you joining and your time, everyone. And we'll see you again next week.